Hey there, and welcome back to Benefit Genius. If you're nearing retirement or already in it, you've probably heard the saying, nothing is certain except death and taxes. Benjamin Franklin was right when he coined that phrase in 1789. Taxes are a part of life, and while death might seem a bit further off, taxes are something we can't avoid, especially when it comes to Social Security and Medicare. But how much do we really know about taxes on our Social Security income? In today's video, we're diving into the taxes that affect your Social Security income, especially in 2025, and giving you everything you need to know to plan ahead. Let's face it, retirement planning can be stressful, and taxes make it even more confusing. Maybe you've heard from others that their Social Security income is being taxed, or perhaps you're wondering if yours will be. Well, you're not alone. Many people are caught off guard when they realize they're still paying taxes on the money they thought was tax-free. In this video, I'm going to break down exactly how Social Security taxes work, how much you might pay, and what changes are coming in 2025 that you need to be aware of. If you're in the middle of planning for retirement, this video is for you. Let's start with how Social Security taxes work in the first place. When you're working, you contribute to Social Security and Medicare through FICA taxes, Federal Insurance Contributions Act taxes. If you're employed by someone, you're paying 6.20% of your income into Social Security, and your employer is matching that amount. That's 12.40% in total if you're self-employed, because, of course, you're responsible for both sides of the tax. But here's the catch: there's a limit on how much of your income is subject to Social Security taxes. This is known as the max tax, and the limit for 2025 is set at $176,100. So, here's the good news. Once you earn above that threshold, you don't have to pay Social Security taxes on the extra income. But you're still going to pay Medicare taxes, and we'll talk about that in just a minute. Here's where it gets tricky. After all the years of paying into the system, you finally start receiving Social Security benefits. But guess what? You're not done paying taxes. Not everyone will pay taxes on their entire Social Security benefit, but a good portion of retirees will pay something. And this is where understanding the formula for taxation becomes important. The IRS uses something called provisional income to determine how much of your Social Security benefits are taxable. Provisional income is the sum of your adjusted gross income, AGI, any tax-exempt interest you might have, and 50% of your Social Security benefits. Let me break that down for you in simpler terms. Start with your adjusted gross income, AGI. This includes all your income, wages, pension income, interest, and dividends. Add any tax-exempt interest you might have, like from municipal bonds. Add 50% of your Social Security benefits. For example, if you're receiving $24,000 a year in Social Security benefits, you'd add $12,000 to your AGI. So, if your AGI is $30,000, your provisional income would be $42,000. Now, once you know your provisional income, you can determine how much of your Social Security benefits will be taxed. Federal tax rules are designed so that lower-income individuals don't have to pay taxes on their Social Security income. But, once your provisional income crosses certain thresholds, a portion of your Social Security benefits becomes taxable. Let's look at the numbers for 2025. If you're a single filer and your provisional income is $32,000 or below, you won't pay any taxes on your Social Security benefits. If your provisional income is above $32,000, but below $44,000, then up to 50% of your Social Security benefits are subject to taxes. But, if your provisional income is above $44,000 as a single filer, up to 85% of your Social Security income will be taxed. For married couples filing jointly, the numbers are a little higher. If your combined provisional income is under $44,000, you won't pay any taxes. But above $44,000, and you could be paying taxes on up to 85% of your Social Security benefits. Now, 41 states don't tax Social Security, which is great news. But, there are still 9 states that impose state taxes on Social Security income, and the rules vary widely. For instance, Colorado allows you to subtract the full amount of Social Security benefits from your state tax return if you're 65 or older. Other states, like Connecticut and Minnesota, have income thresholds above which you'll pay taxes on some portion of your Social Security. If you're in New Mexico, Rhode Island, or Utah, there are also different state tax rules for Social Security. Each state has its own unique system, so make sure to do your research and find out exactly how the state you live in will tax your Social Security benefits. Now, let's talk about Medicare taxes. In addition to Social Security, you also contribute to Medicare throughout your working years. Here's how it works. For most people, you pay 1.45% of your wages toward Medicare, and your employer matches that amount. If you're self-employed, you pay 2.90%. However, if your income exceeds certain thresholds, $200,000 for single filers or $250,000 for married couples, there's an additional 0.90% tax applied to the income above those thresholds. But Medicare isn't just about paying taxes during your working years. When you start receiving Medicare benefits, you could end up paying more if you have a higher income. The Income-Related Monthly Adjustment Amount, IRMAA, is an additional charge on your Medicare premiums if your income exceeds a certain amount. If you're a single filer with a modified adjusted gross income above $106,000, you'll start paying higher premiums for your Medicare Part B for married couples filing jointly. The threshold is $212,000. If you cross these income thresholds, you'll pay an extra charge on top of your regular Medicare premiums, which can increase your total cost by several $100s per year. Now that we've broken down how Social Security and Medicare taxes work, let's talk about strategies to minimize your tax liability. One effective way is to plan for your income. By keeping your income below certain thresholds, you can avoid paying taxes on your Social Security benefits. You can also use tax-advantaged accounts like health savings accounts, HSAs, to reduce your taxable income. Contributing to an HSA allows you to deduct contributions, grow your savings tax-deferred, and withdraw the money tax-free when you use it for qualified medical expenses. In 2025, the contribution limit for a single person is $4,300, and for a family, it's $8,550. If you're 55 or older, you can contribute an additional $1,000. It's clear that taxes on Social Security and Medicare can add up. But the good news is that by understanding the system and planning ahead, you can minimize your tax burden and keep more of your hard-earned money in your pocket. So, let's recap. Know how provisional income works and calculate it to understand how much of your Social Security benefits are taxable. Understand the state tax rules in your area. Keep track of your income to avoid paying higher Medicare premiums. Use tax-advantaged accounts like HSAs to reduce your tax liability. By following these tips, you'll be in a much stronger position to manage your retirement income and keep more of it for yourself. If you found this video helpful, make sure to hit that thumbs up and subscribe to the Benefit Genius channel. We release new videos every week with more tips and insights to help you navigate the complexities of taxes and retirement planning. And don't forget to drop your thoughts and questions in the comments section below. What strategies are you using to manage your Social Security income and taxes? I'd love to hear from you. If you're looking for more helpful content, check out our other videos on retirement planning and taxes. There's a lot more to learn.